Good evening to you all. So, welcome back to the international trade and world economy subject. So, today the expectation of the subject is to discuss on the finances and finances in the international markets, as well as in this lesson we are going to concentrate about the exchange rates as well as the balance of payments and whatever the other factors those which are affecting on the financial backgrounds of international trades. Right, so we'll move to the lesson. Now, today we'll discuss about the basic inflows and outflows of an economy. When it comes to the macroeconomics, we know there are so many outflows as well as there are so many inflows in the economies. So, basically, when it comes to the international trades, we can see there are so many exports and imports. You may have heard of these terms. So, what do you mean by imports? We're going to evaluate on these concepts. Imports are basically the things that we bring to the country or bring to the economy from the outer world. Let's say that can be from different countries. And also, what are the exports? Exports in the sense we send some of the commodities from the country. Actually, in our first three lessons, we discussed about the international trade, how it's developed, and how can we involve in the international trade with our excess quantities and things like that. So, in that case, we export, or let's say we are sending some of the commodities outside the country. So that is how the export happens. Right. So, but even though we got to know about these things, but still we need some sort of definitions to explain all these things. So we'll move to the definitions. Basically, a trade between country happens through imports and exports. We know that, right? So all these imports and exports. Let's first get to know about the imports, right? Imports are the purchases of goods, services from another country, which causes to create the currency outflows from the particular economy. It's obvious that if whenever the time we are import some of the commodities, let's say we are bringing some of the commodities from the outside the country, so we have to spend over them, which means that we have to pay something. We'll say now, as Sri Lankans, we have to pay Sri Lankan rupees for the country that we are importing from. Let's say that is an expense, or let's say that's a cash outflow, or let's say there is sort of a currency outflow from the economy of Sri Lanka, right? So that is what we call as imports. Okay, so in that case we say there's an expense as well as there's a leakage from the economy. Remember, it's clear, right? If your economy is a water tank, let's say if the tap is open, your water will be reduced, the level of the water will be reduced from the tank. So that case, it's obviously clear, it's a leakage, right? Like that, your company, or let's say your economy is having a commodity, or let's say a bulk of cash. In the event where you import some of the commodities from the outside the country, so you may have to pay a sum to the outside the economy. So there is a leakage. When it comes to exports, the opposite of the same thing. What do you mean by exports? Export in the sense it can be that we are having sort of excess commodities. It can be that we have so many industries oriented, actually established for the purpose of exports. So in that case, the exports are the sale of goods, services. It can be either good or the services to another country. Sale of the goods or services to another country, which causes to create currency inflows. Totally the opposite, right? In the imports, we made out cash, that was cash outflows, and in this case we make the cash inflows, right? Which means that we are gaining some income. So it's an income to the economy and sort of an injection to the economy, right? It's an inflow which causes to expand the economy to some extent. With that particular money, the money supply will expand. So it's clear. So we'll move further. So in this case, right, when we are considering about these imports and exports, we have to, at the end of the day, whatever the things that we're looking at, in the sense, we are going to evaluate what are our net exports. That is the difference between the number of exports that we did and number of imports that we did. So in that case, net exports can be explained as the difference between the country's total value of exports and the total value of imports within a particular, or let's say a given period of a time, right? So we can calculate it by, let's think favorably, because we are going to calculate the net exports. So because of that, we deduct the value of the imports from the value of the exports. So NX, or let's say the net exports, has to be a positive figure. But sad to say, in Sri Lanka, it's a negative figure because we are importing so many things than the exports, right? Okay, fine. So it's obviously clear, right? Because since we are importing more, so we have to pay more cash to the imports. In that sense, we have a sort of a deficit in our balance of payments. Fine, we'll move to that. But before that, we have to go with the terms of trades. What do you mean by terms of trades? Terms of trades, it's quite easy to understand this term. Terms of trades, in the sense, we are going to evaluate the trade in terms of whatever we have sent. In that case, let's say we are going to compare both the average imports and the average exports that we made during a particular period. In that case, we say terms of trades measure the relationship among the imports to the exports of that particular economy. As an example, let's say if you have sent 20,000 worth commodity to another country. Let's suppose at the same time you imported 5,000 worth commodities to Sri Lanka. So in that case, you're going to compare this 20,000 with 5,000, that which means that your imports with the exports, that is what we know as the terms of trades. So in that case, simply the measure amount that measures the amount of imports that a country can buy, through the price received from the exports. Anyway, we are earning some sort of money from the exports within a given period. What is the amount that we can import as a result of we being exporting some of the commodities? That is the explanation of terms of trades. We calculate it dividing the average imports for the periods by the average exports for the period, as you can see it in the figure. Right. So I told you now about the balance of payments. What do you mean by balance of payments? Simply, we can have an idea, right? It's like the difference between the imports and the exports. Correct. But balance of payment refers to the sort of transactions. It's not only the goods, but of course it includes the services as well during particular a period of a time, right? A given period of a time. Let's say when it comes to the balance of payment, it's abbreviated as BOP, right? That is for the balance of payments. Of course, the country is a record of all economic transactions, including it can be exports, it can be services, right? So record of all economic anyway, the exports and imports include all these products and services, but to differentiate between these products and services only, I'm mentioning that products and the product exports and the service exports, as well as the product imports and the services imports, right? Record of all economic transactions between the residents of the country and the rest of the world in a particular period of a time. That is the meaning of balance of payments. So whenever we consider about the balance of payments, there are 4 things to be remembered. What are these 4 things, right? Balance of payments is calculated under national accounts in a particular economy, let's say. In that case, there are 4 types of accounts or 4 types of financial figures that we need to calculate all these things. What are those things? The first one is the current account. Normally, you know what the current account is, in the sense that in a particular period of a time, whatever the payments that we made, as well as whatever the income that we received, will be recorded in a sort of account called current account in a country, right? that is under the government. So they can, the government statutory bodies are evaluating what are the income and what are the expense sources we experience during a particular period of a time. So accordingly, they make some sort of accounting. They go through an accounting process and they report some of the incomes and expenses under that particular current account. So there, the current account is nation's transactions with the rest of the world, specifically its net trade in the goods and services, its net earnings on cross-border investments, and its net transfer of payments over a defined period of a time, such as year or a quarter. Right. So then the second one is the capital account. The first one was current account, and the second one is capital account. What do you mean by capital account? By its name, it's obvious that that is related to the assets and the liabilities that a country has. When it comes to the capital accounts, you can see it keeps a track of net change in the net assets as well as the liabilities of a country. It can be the government debt, it can be the public debt, right? As well as the number of investment that the economy has made during a period of a time, right? Which owns by that particular economy. It can be out of the country, but still, if the investment is owned by that particular economy, yes, of course, you can include that in the capital account because it's an investment, right? Whatever the productive things that you made through or through gain through the investment, let's say the income that you made during the period of a time, so that can be mentioned or that can be included in your capital account, right? So net assets and the liabilities during the year. And the capital accounts balance will inform the economists whether the country is a net importer or a net exporter of capital. So the difference between all these capital investments and how you deployed over your liabilities and things shows you who are you, yeah, in the sense who you are. Since are you a net exporter or are you a net importer? You in the sense you are the economy, right? So if your economy is more oriented to import some of the goods, in the sense you will lose most of capital, let's say, right? You will be having sort of public debts as well. So with that, you are a net importer, right? So you import always, right? And also, if you do have so many assets, in the sense you invested some sort of things, invested in some sort of things, let's say the opportunities, so you are a net exporter. So this can be evaluated through the capital account. Hope that you got it. Right. And the next one is, third element is the current transfers. What do you mean by current transfers? Let's say the definition. Transactions in which the resident entity in one nation provides a non-resident entity with an economic value, such as a real resource or financial item, without receiving something of economic value in exchange. As an example, let's talk about the foreign remittances, right? Without getting any sort of, now, when it comes to economics, let's say in macroeconomy, right? In a country, there should be to something to become an exchange, to become a transaction, there should be a value exchange, right? Let's suppose that I and you do a sort of a transaction, right? To become it a transaction, let's say that is an exchange, right? I will give a book to you, but you won't pay anything to me, right? In that case, that is a sort of a free exchange, in the sense that I gave something to you, but I didn't receive any as a return of it, right? I didn't get anything in return. So because of that, we call them, like, it's like the retirements, right? Whatever the lump sums that are received by the elderly people as their retirement payments, right? Let's call them as the pension payments. So those are not active, or let's say those are not effective economical activities, right? That is sort of one-way transactions. Government or the companies are paying them, right? Let's call them as corporations. Some of the government corporations are paying them, right? So those should not included in the economical activities, because those are like non-effective, or let's say ineffective economical activities in the case. But some sort of remittances, let's say, As an example, let's assume your father is working abroad, right? So he's getting some sort of a money from there. He's earning actually. So his earning can be taken into the consideration in a current account. Whatever the things that we gained here also, it counts. Why? Because he remits his money to Sri Lanka as a part of you being a part of his family, right? In that case, you will receive the sums. So those are under the current transfers. Not only that, but also you can consider the business transactions as well. But there's nothing called effective economic activity because you are not going to give something in return, right? He pays you, but you will receive it, but you don't pay or you don't even give sort of a commodity or whatever, right? So that is not an effective transaction. But that sort of, not that it's been effective but ineffective, but we are going to get those types of transactions into the current transfers, right? So then the next one is the current account deficits. So this is a very crucial point where we have to consider. What do you mean by current account deficits? Now, when it comes to the definition, let's say the measurement of the current country's trade, where the value of the goods and services it imports exceeds, remember, exceeds the value of the product it exports, right? Country's trade, right? Measurement of the country's trade, where the value of the goods which are imported exceeds the value of the net exports, let's say the exports. So which means that again the net exports will be getting a minus value because the imports are high. The current account includes net income such as interest and dividends and the transfers such as foreign aid, although these components make up only a small percentage of the total current account. Now see, if there's a deficit, sort of unfavorable circumstance to an economy, right? You have to remember all these things. Fine, we'll move. So when it comes to the exchange rates, now we all know what the exchange rates are, right? What do you mean by an exchange rate, right? The reason that you have to know all these things in the sense you will make or you will conduct whatever the foreign trade agreements or let's say foreign trade affairs based on the exchange rates, right? You do the transactions based on the exchange rates itself, right? So first we'll get to know about the exchange rate, right? The exchange rate can be defined as simply the rate which one country can change its currency to another. Let's say it's one way of defining, right? A rate which one country can change its currency. Let's say if we are going to do a business transaction with, let's say, India, so we have to translate our LKR, that is Lankan rupees, into INR, Indian rupees. So that is a rate between, right? Or simply the value of one country's currency in relation to the other is known as the exchange rate. So there are several things which will affect over the or which affects over the exchange rate determination, right? Determination of the exchange rate. So what are those? Now there are so many factors. I took 8 factors to be explained, right? So the first one is the inflation rate. What do you mean by an inflation rate? Now in macroeconomics we have to know all these things, right? Inflation is basically an increment, or let's say the continuous improvements which are happening in your general price level, right? In a particular country in a given type of period, let's say there are so many types of price indexes, right? But when it comes to different types of price indexes, we normally we consider the consumer price index in Sri Lanka. When it comes to consumer price index, let's say there are so much of commodities, let's say different types of necessary goods are mentioned in that particular, let's call it as a basket, right? In that particular basket, there are so many products mentioned. So in a particular, on a given period of a time, if the prices of those are continuously rising, so we call that particular condition as an inflation. So in that case, it's obvious. Now these things are happening, just it can be because of the demand. We'll get an example of demand pull inflation situation. Now what is going to happen to this country, right? Because all these government is issuing some of the loans to the people, and also some of the government loans are not recovering, so because of that the people are having money, right? But of course when it comes to the commodities, you don't have the enough commodities to be bought, right? In that case, the demand is higher than the supply. As we have discussed, there's a supply curve and the demand curve. So in the case of let's say in a demand, if the supply is greater than the demand, of course that's fine. But when it comes to the demand is greater than the supply, so the suppliers, let's assume that there's no any price mechanism where to, the government intervention is less, so because of that you cannot control over the prices. Because of that, the suppliers are not in a position to give you whatever the supply to the as per the demand, right? Because of that they have to increase their prices day by day. It's increasing because of the higher demand, right? So the people, those who can have you know have the capacity to pay over the higher rates, let's say the high affordable income, right, the high affordability, uh, they will buy them. In that case, the general price level will rise, right? That leads to the economy to an inflation situation. Well, in the case of inflation, your exchange rate will be determined by that particular inflation rate, right? I will upload a glossary, or let's say a document to this discussion, so you can see it again, right? You can refer it. Then the interest rates. In a given economy, let's suppose that the with the changes which are happening in the interest rates, that can also determine on the changes in the exchange rates, right? And the balance of the payments, as I told you earlier, the net exports, right? Imports minus exports, or let's say exports minus imports. If it's a minus figure, those types of minus or positive figure, both the figures can define on the nature of the exchange rate, right? And when it comes to the government debts, if the debts are higher in the sense we have to pay more sums as the interest as well as the installments. So because of that, it can be a deficit of the capital accounts, let's say, since the liability is high, right? In that case, those can also determine the nature of the behavior of the exchange rate. And terms of trade, I told you about the comparison between the average number of the commodities whatever we have sent, or let's see the exports as well as the imports. So these things can also define on the exchange rate. Political instability and statutory performances can also decide over the things. Now, the continuous improvement or the continuous inflationary situation is known as a recession, right? So that can also give a major impact over defining the exchange rates, as well as the speculation income. Speculation in the sense that is the intention to gain the profits through doing some of the business transactions, or we call them as exchange transactions, right? Mostly the business people are trying to, they do exchange some of the, let's suppose now if there's a trend to increase the value of the USD in near future, so the customer, or the let's say the customers of that particular market, right, the finance market will tend to buy more USDs, right? Because of that there will be a higher demand, right? So with that, there will be a sort of a high demand. Because of that, the rates will go up, right? With that, the exchange rate between the other countries will be determined by that particular sort of the change, or the difference, or let's say that the increment happen in that particular currency, right? Okay, so we'll move. Now, I just want to actually elaborate on one concept that is called exchange rate risk. Whatever we are discussing on the international trade and international trade financing, right? So basically, exchange rate risk is also included in this lesson, and it can be known as currency risk. Is a financial risk arising from the fluctuations of the value of base currency against the foreign currencies in which a company or an individual has assets or obligations. I've just included in here, but because mostly the people, those who are involved with the exchange, or let's say the foreign trade, are often dealing with all these financial risks known as the exchange rate risk, because if there are sudden fluctuation of a given sort of a currency, so that might affect over the that may definitely uh, affect over the business transactions of them, right? Okay, so then coming to the appreciation and the depreciation of exchange rates, right? It can be you may have heard of, right, devaluing of a currency of a country. Yeah, so which means that, let's suppose that if we can, let's get a simple example, right? For 5 rupees, if you can buy 5 numbers of toffees, on the next date, if you cannot buy 5 toffees from that particular 5 rupees, let's say the toffees are imported, right? In that case, we say uh, the rupee value is devalued, right? That is a depreciation of a currency, right? Let's say, now when it comes to appreciation and the depreciation of the exchange rate, right? You must carefully remember this, right? What do you mean by appreciation of exchange rate? Appreciation. Currency appreciation is the increment in value of a country's currency with respect to one or more foreign reference currencies. As an example, let's say now today the USD is worth of rupees 200, right? Let's suppose, hopefully, on the next date, the rupee value of a dollar will be 190, in the sense it's the appreciation of rupee value, right? So currency appreciation is the increment in value of a country's currency, right? It's an increment, right? Then when it comes to the depreciation, it's the opposite of it. Let's suppose now today the currency value is 200. Tomorrow, if the USD worth of rupees 250, in the sense we are devaluated, right? So in the sense that we have depreciated our currency value. So in that case, currency depreciation is a loss of value of country's currency with respect to one or more foreign reference currencies, right? In a depreciation, what happens is that is favorable on the balance of payments. Why? Because to import more commodities to Sri Lanka, now let's suppose we imported 5 numbers to Sri Lankan economy from whatever the commodities, right? 5 numbers, which would cost around, let's say, 1000 rupees, right? 5 numbers, 1000 rupees. In the sense, each will cost around 200 rupees. So that is today's case, right? But tomorrow, if we have to pay 1500 rupees to bring the same commodity to Sri Lanka, in the sense, let me ask you one question. Are you going to deal with that particular deal? Are you going to do that particular transaction? No, obviously not, because you have to pay 1.5, I mean 1500 to buy the same commodity, right? It's not a favorable occurrence, right? Because of that, you will limit the imports, in the sense, let's suppose you will buy only 3 commodities, right? That is to fix at 1000, right? Without spending 1500. Because of that, your imports will be less. And at the same time, let's think, constantly you do the exports, right? So in that case, that is very favorable over the balance of payment, because it will expand your export income, rather the expenses you incur on the imports, which is very favorable. When it comes to the other side, let's say an appreciation. If a Sri Lankan 1,000 rupee can buy seven numbers from that particular good, you will definitely buy that seven numbers for 1,000. In that case, you will lead number of imports than its exports, which means you will import more than the numbers that we export. I mean the currency values, right? In that case, that is adverse, or let's say that is unfavorable to the balance of payments. Right, we'll move further. So this is today's last part. I'm going to elaborate on the nominal versus real exchange rate. So since these things are definitions and sort of emphasizing on the definitions itself, so we'll go with the slide. What do you mean by nominal exchange rate, right? Nominal is number of units of the domestic currency that are need to purchase a unit of given foreign currency. It's obvious the number of units of the domestic currency that are needed to purchase a unit of a given foreign currency. As an example, I've given you an example. If you want to, like, let's say, for an example, if the value of the euro in terms of the dollar is 1.37, this means that the nominal exchange rate, right? Remember, these are nominal exchange rates, right? Nominal exchange rate between the euro and the dollar is 1.37. But when it comes to real in the sense the actual commodities that you can buy, let's say, let's suppose, right? These are not monetary value. Then when it comes to the real exchange rate, we call it as the good value. The real exchange rate measures the price of the foreign goods relative to the price of the domestic goods. Right? It's a comparison between the foreign and the domestic goods, right? The commodities. You will consider about the numbers that we can buy. Like as I said, the 7 or the 5, right? In the previous case. Okay, so these are the things that we had to discuss today. Hopefully we'll discuss about the exchange rates and some of the economical impacts and some of the financial matters in our next session. So thank you very much for being online to watch this session.